Good evening, ladies and gentlemen. Welcome to Learn with Stanley webinar number 46. Thank you so much for joining me this evening. And today we have a great topic for you guys, which is how do we start decoding financials numbers into a detailed story of the company that we want to understand. So let's get started. So if you look at this financial statement right on the onset, it will look very confusing to most of us. Let me give me a minute. Yeah, it will look very confusing for most of us, and it will take a lot of time for us to truly understand how to read a financial statement, possibly in understanding what is fully trying to tell us, all the ratios that people talk about that we have to understand, and then running through doing Excel sheets after Excel sheets of discounted cash flow to find its valuation. But today I'm not gonna spend so much time talking about the traditional process of learning how to read financial statement. Instead, I'm gonna use a real life example together with all of you and using a little bit of common sense that I wanted to highlight and share with you guys that you can learn how to read a financial statement and interpret it into a well detailed story of the company that you're studying without any financial knowledge that you might have previously, right? Even if you have never read a financial statement before, even if you're not accounting trained, I'll just share with you some of the basics and a little bit of common sense that you just need to have a head start on understanding financial statement. Right, my name is Stanley, and please note that today the webinar that I am presenting to you is a webinar that is prepared by myself and in no way represent that of my employer, which is iFast Global Markets. And do note that the information that I provide here is mostly for educational purposes and does not constitute any financial advice. I'm not asking you or recommending any companies to you, but using it as an example to showcase how we can interpret a financial statement. So welcome again to Learn with Stanley. And this is a bi-weekly webinar that I will do for all my clients and also people who are interested to find out more about finance and also about investing. And you can join the private invitation list, or you can share with a friend who you feel that will benefit from all these webinars that I'm doing at learnwithstanley.com. If you are new to me, I myself has been sharing investment content on the internet for I think close to a decade now, and um, in around close to 8-7 years ago, I have written a book with my co-writer Man Hong on a book called Value Investing in Asia, and that really kickstart our sharing on my blog valueinvestasia.com, and then now with Learn with Stanley as well. And I mentioned just now that I am currently a wealth advisor with iFast Global Market. And iFast, if you have not heard of the company, is basically a wealth management platform that allows you to manage your entire investment through one platform. And you can access all investment products out there, being unit trusts, bonds, our in-house managed portfolio, even just cash management, and of course, a brokerage account for you to trade stocks and ETF as well. So something a little bit different that of how I typically do compared to how I approach my clients is really not starting from the point of investment, but rather I start with the point of financial planning. And with software tools that I use, I try to understand a little bit more about the real situation that my clients is facing. Maybe, for example, recently have a chat with a client of mine, and they are retired, but they have been working hard all their life, but they're very very worried that not very sure if they have enough for their retirement. So and then that's why they have been very conservative in their spending, and tends to be very worried when it comes to investment. But when I sit down and talk to them and then run through the simulation from them and understand their current status, I realize that they have more than enough for their retirement, to maintain their current lifestyle, and for even a little bit more, right? And leaving something for their children. So that really gives them more ease of mind, and also allows us to plan the investment in a more appropriate manner, of finding the real objective of why they need to invest. Should they take the necessary risks, if they or they should be more conservative over time. So if there is something like a process that you want to go through with me as well, you can uh, find the contact detail through this QR code. You just send me, please submit the Google form, and then I'll try to reach out to you to walk through and discuss a little bit more of the question that you might have on your financial planning journey as well. So I'll not spend too much time on that. And today, let's get to the cream of what we're going to discuss, which is how to decode a financial statement into a detailed picture and detailed story of the company that we want to understand. The topic is very vast, and it will require some time of concentration from your part as well. So what I'm going to do is I'm going to split this portion into two parts. So today I'm going to talk a little bit about the first part of understanding the financial statement and interpreting it. But then the next 2 weeks later, we're going to have part two, where I will go through with you a real life example of how we can use this knowledge that we have gained and analyze fully a company and come to a conclusion, or whether if that is a company that you want to invest in. So the main four key parts that I'm going to talk to you about is understanding that every time you read an annual report, it is really a bedtime story. And I have spent close to 20 years now reading annual reports, hundreds and hundreds of them, to the point that now most of the time, if I look at the financial statement and look at the annual report, most of the time within 5 minutes, I would be able to at least know that if this is a company worth my time, and if this is a company that I should be investing more time in to see if it is an opportunity to invest, right? As you become more and more experienced, you'll be able to siphon through and filter out companies that really worth your time, and zoom in to invest in only the company that suits your investment strategy, right? Those includes understanding the income statement, the balance sheet, and of course the cash flow. And then from these three financial statements, just three financial statements, how we can put it all together to tell a real story of a company. And of course, in the next part of the webinar, we're going to run through real life example of just how we can do that. Okay, so what is an income statement? An income statement is one of the most important part that we should look at when we are looking in an annual report of a company. And why I'm showing you this short clip is because in my mind, income statement is basically a short video of what the company has done throughout that year, right? And that is the key thing. Income statement is recording a period of time, or the activities of a company across a period of time. And most of that, the period would be a one financial year, which is 1 year, and that could be from January to December. It could be from July to June. It depends on where the company marks their end of financial year, and typically every single year, the income statement will show us how it performed over that period. So this is a real life company financial statement, and this is the income statement, which ended in December 31st, 2004. So it's the one full year of what the company has done. At first glance, it is very confusing, but let's break it down one by one today. And in this webinar, I'm going to need a lot of your participation. So don't be shy, click up the chat box, right? Let's try it now. Let me know where you are joining in from on the chat box. Say hi to me and let me know where you're connecting from. And along the way, I'm going to be asking some question to you and you can have a feedback with me. I'll try to interact with you guys as much as possible throughout the program. So don't be shy. Let's have a discussion today. And we'll take it one step at a time, right? Instead of looking at the entire income statement, let's just look at three lines, the top three lines of a financial income statement: the turnover, or sometimes referred as revenue, cost of sales, or cost of goods sold. These are just different names, but they mean the same thing, and gross profit. So I'll go through it one by one. And just from these three lines, we can already tell a lot about this company. And share with me from these three lines, what can you tell about the company, right? So turnover is the revenue, um, and cost of sales or cost of goods sold is basically the direct cost that is associated with them generating that revenue. Say for example, uh, if they sell a phone, right? If they sell a phone, the direct cost of component and the direct labor cost of creating this product will be put under cost of sales, and the gross profit is basically what's left. And from here, we can work out the margin, the gross margin of a company, meaning that if this is a company that is selling phone, for example, they sell about 6.4 billion of it. They have a profit of 1.5 billion from the direct cost of this product, right? So meaning that they have marked it up around 20%, yeah, roughly about 20%, right? To sell the products. So let me know, what can you learn from just three lines and the 2023 numbers and 2024 numbers of the revenue, cost of sales, and gross profit of the company. I'll give you 5 seconds, right? So here are some of the key things that, just at a full quick glance, we can find out about what this company is trying to tell us. Yes, Victoria, there's a great observation. Exactly. Right. For most companies, what we want to see as investors is that this company, year on year, they should be growing. We want to invest in a growing company. We want company to be doing better and better every year, because in most situation, we have a inflationary environment, meaning that our money is becoming smaller and smaller every year. So a company earning 1 billion this year and earning 1.05 billion next year, in real terms, is actually stagnant, right? It's not moving at all. So we want a company that's showing at least some growth, that it can grow together with inflation. And just by looking at these three lines, number one, I can see that this company use Sing dollar as a base currency. So there's a big puzzle that, oh, this company might be a Singapore company, might be based in Singapore, or might be doing most of its business in Singapore. Either way, right? That is using Sing dollar as a base currency. And the revenue, when we just look at one line of the revenue, it's 6.4 billion. Last year is about 7 billion in revenue. So this is actually a pretty big company, right? And they do business in terms of billions. But sadly, the revenue is dropping about 9%. And that's not a good sign, especially 2003, 2004 is the kind of environment that we are experiencing the highest inflation in many, many years, right? Inflation was the key concern for many people over the past few years. And yet, in an inflationary environment, this company has failed to grow. So maybe it's telling us that this company might not be in the industry that is doing so well, right? And seeing a revenue that is declining. And not only that, its gross profit is also declining, but the gross margin actually improved 2023, 22, sorry, 22% to 23.5%. So why is that the case? Because for a large company, typically, is that this large company, why they need to grow and grow themselves to become larger and larger? Because a lot of them will say that as they go larger and larger, they would have economic of scale. And if they have economic of scale, meaning that things that their costs should become smaller and smaller to them in terms of percentage. So meaning that if they have economic of scale, their margin should actually improve. And yet this company is showing us that while economic scale drop, like the revenue drop, and yet the margin is increasing slightly, albeit so slightly. Does that mean that its raw material maybe is not a function of scale? Maybe the raw materials has their own commodity markets, and it's up to the market to decide the prices, and the company don't really have a lot of pricing power over that, and so it will be a little bit more volatile. Just from these three lines, we learn a lot about this company already, right? It might be a Singapore company, it might be it might be a company that is large in a large industry, but not so sexy industry, and is not doing so well. And its cost of goods, its cost of sales and cost of goods, it might not have that big of a pricing power over it. Pretty good information just from three lines of numbers. So let's get a little bit deeper, right? This is the next few lines of it from the gross profit. We have the general and admin expense. This is another simple term for it is what we call SG&A. And is basically administration expenses. So the salary of the staff, the transport, sometimes some of the transport costs, or maybe the R&D, things like that would be within these expenses here. So how to the operating costs of the offices and things like that, the rental most likely will be under here. Other operating income, most company would have this. These are income maybe not coming from the core business. It could be from maybe selling some scrap metal, maybe some rental income. If rental is not their main business, would be parked under here. Some foreign exchange gains might also be parked under here sometimes. Then we have the non-operating income and non-operating expenses. So this could be a one-off expenses that is unexpected and shouldn't be things that they constantly will reappear. Typically, they're not very big. Sometimes it could be big, like FX, or once in a while if they are disposing of businesses, then they'll see some gains over here, right? And next we have finance income and finance costs. This is directly from, say, the interest that they have if they put their money in fixed D, if they purchase some bonds for their treasury department to managing their cash. And the other way around, finance costs is if they have debt, they have to service those debt. Those is the interest costs that they are paying for that. And then lastly, for this company, they have shares of results of associate and joint venture. So what this means is these are companies that they have invested in, but they don't fully control it, right? Maybe they are just here, they're just there as an investor. So associate, typically these are companies that they invested around 20 to 50% of the company, and they don't really have full control of the management. So whatever this company is making, then the net profit will be their portion of the net profit. So if 20% of whatever the company is making, their shares of the profit will be parked under here. Similar. And joint venture typically we're talking about companies that maybe they have another big partner, 50-50, 49-51. They have substantial stake, but still not a company that they fully manage completely. And the results of this company on a net profit basis will be parked under here. So again, just looking at the next few lines of this company, what can you tell? Maybe each of you can share with me one key observation that you found about this company. And I'll go to the next slide and share a little bit. Those of you who has just joined in, feel free to click up the chat box and then make a comment, right? Don't be shy. So let's get on to it. Here are some of the things that I wanted to highlight to you. There are many more, right? Just want to share some of the key main points, which is if we look at the numbers here, we can see that the admin expenses, even though the business is going down, the admin expenses grew about 10%, right? From 2003 to 2004, grew about 10%. So the salary of the staff and everything is growing according to inflation, right? Inflation over the last year was very, very high. And yet the business is not. So something to take note of. And we can maybe find out a little bit more about what are some of the non operating income for this company in particular. When I dig a little bit deeper into the financial statement, these are some of the income that they are getting from what they call deferred profit. Some of it can be from long-term projects. Some of it can be from company they have sold off, but they have some delay payment agreement, and those will be recognized in the future. So this will be parked under here. And then we can see that the finance cost is actually much higher than its finance income. What does this mean? Straight away, it tells me that this company might most likely have more debt than they have cash. So this will be a company that is in quite high debt level, so that their finance cost is pretty high. And then their shares of results of associates and joint venture, 317 million. When their operating profit, this one profit before tax is what we also call operating profit, is about 1.25 billion. So it's a substantial amount. About 25% of their operating profit comes from their associate and their joint venture. Luckily, the associate and joint venture are doing pretty okay. Their profit is up 20%. But it also shows that this is a company that makes a big part of their profit from external investment, right? They're investing in other companies that are doing the work that give them a big part of their profit as well. Whereas their real business might not be as profitable as they hope. So, did you get that? Right? So, just from a few lines and just from this one statement, the income statement, we are gaining a lot of information about this company. And this is just 1 year. So typically, when I was getting started and understanding how to read financial statement, a lot of time I might be reading 10 financial annual reports of a company to fully understand the company, right? So I might be reading 10 years. If today we have up to 2004 annual report, I might dig my way all the way back to 2014 financial statement and read it all the way like a novel, right? Of a long series of how the company developed over time. It's actually better if you read it from the start instead of reading the latest one and then going back, right? Typically, what I do is I'll read the latest one uh, and get a glance of what I'm dealing with, what kind of company this is, and if it piques my interest and I feel that this company has potential to be one of my investment, then I'll read through uh, from the beginning, like 10 years ago at least. So this has been more or less how I have done it, and over the years, it also helped me develop this skill set to quickly observe a financial statement to understand the real story behind the company. Next, let's finish up on the income statement first. And this is the final few lines of income statement after the profit before tax. So before they are paying tax, another name for it is operating profit or operating income. They are making 1.25 billion, and they are paying some tax, and then end up with their net profit. They have a interesting line here called loss from discontinued operation. Typically, most company wouldn't have this line, but they have for this one they do. And basically, these are the profit or loss from a company that they uh, did not own for the full year. Maybe they sold it off in June or July, and they are marking off just the part where they have owned the company. Hopefully, it is a small amount, right, for most of the company that you look at, and then this will be the net profit. But what is interesting is we should always read all the way down, and you will come to this line called profit to either the owners or the non-controlling interests. So the owners is the investor. So if you're invested in this company, you are the owner to this company. And what is due to you is actually this number, 1.011 billion, instead of their net profit, which is 1.036. And they have some external parties, external investors that have earned about, this is 25 million from the entire pie. Why is that the case? I'll share a little bit more, but just from these few lines again, what we can gather and what we information that we can find out more on is that the from both sharing, the tax rate is only about 16-17% or even less sometimes, right? It is of course, tax calculation is not direct from the profit before tax, right? There are other adjustment needed, but this is a good gauge, right? We are not the accountant, so we don't need to go into too much detail of how to adjust for it to find the real tax rate of it. But this is good gauge for us that the tax rate is around 16-17%. And again, it gives us the idea on which jurisdiction is the company operating in. Um, right? Again, highlighting the fact that it could really be a Singapore company with the tax rate around that range. Next, they are selling some companies, and it seems that they have sold some company in 2023 as well. What's it could mean that maybe this company is going through some restructuring. Why are they selling some company every single year? Why do they have so much non-controlling interests in associate and JV? All these are giving some clues of us understanding this company a little bit more. So if right now, when we look at the company that earning about 1 billion from a revenue of 6.4 billion just now, we're looking at a company that is generating a net profit of about 16-17% on a net basis. Seems pretty good. But if we adjust away the profit that's giving us from joint ventures and also from associate, because remember, in those numbers, it is only showing us the net profit straight away, right? It doesn't give us the revenue of all these associate and joint ventures of what they're doing. So in a way, if they have very, very high profit coming from associate and JV, it inflated. It give us the illusion that the profit margin is pretty good, 16-17%. But if you adjust it away, the core business, they're earning about a 10-11%. They're still decent, but hardly, in the range of 16-17 net profit region. CH, you're asking a very, very good question. Just read it out for the benefit of everyone. You're asking that why is the sale of a business showing negative here? So this is actually not showing that the business that they sold at a loss, but rather it is the business that they have sold. So maybe this is a business that they sold in June. So they only operated this company for 6 months, and within these 6 months of this company that they have sold out, right? This company has made a loss during that period because that period where they are still under control, that period they have made a loss of about 9 million during that period. And the business they could sell it for a loss, they could sell it for a profit. Those will come inside here, right? It could go into non-operating income, or it could go into non-operating expenses if they have make a losses uh, by selling the company based on what is declared on the books, right? That's a little bit more detail, but extremely good question. Thank you for asking that. Okay, so these are some of the key ideas that the company would show us just from one statement. So we only go through 1 year of financial statement, and we know pretty much a great deal about this company. This could be most likely a Singapore large cap company uh, in the industry that is maybe not doing so well, and a company might be in the midst of doing some restructuring, right? They're moving the asset around a little bit, and a big part of their profit actually come from their investment outside, right? I wanted to highlight also that financial statement is a product of some liberty of interpretation from management, right? So no two account is exactly the same because the management of different companies might give different assumption to interpret the business, some leeway of how they want to interpret their business, right? And although most of us, we just take it as face value, but there are ways that the company could throw us off uh, when they're doing their financial statement. So sometimes, for example, if a company wanted to boost their revenue, right? Say maybe this year their management KPI is based on the revenue of the company, and to the management they just want to boost as high of revenue as they could, right? Not caring so much about the bottom line. So sometimes they can maybe reduce the margins of the company so to boost volume and then increase the revenue up. And we can tell that by the decreasing margin that they're facing. Or a more common approach that company do is extending longer and longer credit to their customers, right? Especially if they're not in the retail space, uh, if they're into the B2B business, maybe most of the time they're giving a 30-day credit term to their customers to boost volume. They'll say that, oh, we're going to give you 60 days, 90 days credit volume. So why don't you take more from us? Because this offer only lasts for the next 15 days. And so from that, then they will boost the revenue up, but customers might not have paid them back. And that could lead to a number of mismanagement as well if taken too far. So there are many, many tricks that companies will throw us off. And it is something that as we read more and more, especially when we read from the past years all the way up, and you'll see how these things unfold, right? Some of the my key hobby in the past is reading up on companies that has gone into crisis or are caught having some caught in a fraud. Then I'll look back, right, before everyone found out, how are they reporting their financials, what is happening, and what led to the discovery. Um, of course, if you guys are, I guess, my age, one of the first company that I learned about is Enron. And during my time, I think when I was about 20, right, in university or just starting out working, it was a big case. And I have never heard of this company. But as I read through the books, I read through the view through the documentary and read through this financial statement, really give me a very clear idea on how the management was able to pull it off, and kind of trick the investors into thinking that their business is doing better than it really is. Okay, so these are just some of the key nuggets I wanted to share with you guys. Next, we can touch a little bit more on the next statement, which is balance sheet. And like I said before, the income statement is a video shoot of a company through a period. And in the same context, the balance sheet is actually a snapshot of a company frozen in one particular time, right? And this is basically a snapshot of the company on the day of December 31st, 2024, right? So basically, all the things that the company own and all, and its liabilities and its asset, and its cash in the bank, the money it owes its supplier, the money that they owe the bank. At that moment of time, the accountant is taking a snapshot of the company. So you can see it as that way. So every single day, the balance sheet of a company will change, right? Just because when you see that the company has 1.5 billion of payables that they have to pay supplier, right? Maybe on the 1st of January, they clear the check and this number will change. So do understand that a balance sheet is a snapshot of one particular moment of time of the company. And it's basically made up of three portions: the asset, the liabilities, and the equity, right? Even if you don't know accounting, it's very simple. The asset is everything that the company owns, everything that it has under its care. The liabilities is everything that the company owe to someone else that they have to pay back, either the banks, either their supplier, either their employee, the unpaid salary will be all under liabilities. And then whatever is left is equity, and that belongs to the shareholder of the company. So we have the formula: asset is equal to liabilities plus equities, or asset minus liability will be equal to the equity of the company. So you see many lines, and we'll take it one step at a time as well. Because there are a little bit more items, right? Some of the smaller items we might not touch on for too long, but I'll still go through with them with you. And at any point you have any observation, again, I love to have your thoughts. Feel free to pull out the chat and let us know one particular observation that you found just by reading through each section. Or if you have any question as well, you can put it in the chat as well. So the first part of most balance sheet, they will share with us the non-current asset. So asset and liabilities, they will be split into two main groups: current and non-current. Non-current are basically things that we can see that the company is having them for a long period of time. So typically more than 1 year, because 1 year is the financial statement, financial period of a company. So anything that need to be settled within this year will be put under current asset. Anything that might take multiple years to settle or to own, or they have owned for many years, those will be parked under non-current, right? So non-current asset are things that the company has owned for a long time or plan to own it for a long period of time. So of course, this will include the property, the plants, and the equipment, right? So the whatever, if it's in manufacturing, the equipment, the factory that they have, even the computers that they have will be put under here. And you can see that for this company, they have 8.3 billion of it. They're actually investing a lot from 6.4. So even the business is going down, but they are actually investing a lot more into property, plant, and equipment of the company. So before I go on, right, you might ask, why is there a company and a group uh, column? And basically, for us as investors, most of the time we just need to look at the group side. So because most listed company are large companies, they would not just have one single company doing operating everything. So most of the time when we invest in the company, we're investing in what we call the holding company, right? It's a holding company that don't have any business on top, and then below it they have their operating business. They could have one business, or they could have multiple business within the same group, and then those are the business that go out and make the profit. But on top here, this company is just a holding company, is basically the owner of all the other companies that is making money for it. So the company itself might have very, very few things, but the entire group, because if they own majority of whatever business that they have, everything can get consolidated and seen as one. So for investors, typically we just look at the group. Okay, investment property, I think it is self-explanatory. It's could be property that they have just invested in, but not core to their business. Maybe they have invested in workers' hostel, or they have invested in a additional factory that's currently rented out. All those will be put in investment property. Next, investment in subsidiary, you can see that is zero because you have consolidated everything, but the company itself, they have invested, which is the money they have pumped into their subsidiary. Okay, and their associate and joint venture here is the one that we mentioned just now in the income statement, or why they generate a big part of their income. You can see that they have also invested a lot into these companies. So these companies could be one, could be many, but they are now valued at 2.7 billion inside the balance sheet of the company. Next is intangible asset. These can appear in multiple ways, but for the most part of it, I would say that we just see it as a accounting adjustment. Basically, if they have invested in a company above their valuation or above their book value, in order to balance out the asset and the liability side, uh, they will need to account for something called intangible asset. Or it could be something that is real tangible, such as a patent that they are valued, that's put under intangible asset, right? Then this is unique to this company only, called DPN, uh, deferred payment note, I think, deferred payment note receivables. And you can see that it's quite big. So these are coming from very, very long-term projects that they have not received back, or very, very delay payment for some of the asset they have sold out as well. So it's parked under here. So if they don't sell other things, this should come down over the years as they collect the collectibles back, right? But this point is a little bit more unique to this company in particular. Next is trade receivables. These are just amount that customers is owing them and have not returned back to them. And what I wanted to highlight is that money that customers have yet to pay them normally is parked under current asset. But in this case, there are quite a lot, about 800 million, parked under non-current asset. So this means that these are amount that the customers might not pay them back for the next year, right? Again, this could be coming from long-term repayment projects. So these are already telling us a lot of things that this company might most likely is in the B2B space, right? They sell to other companies and most likely very, very large companies as well that has pricing power over them, maybe governments that they're selling to that can dictate that I'm going to pay you back in the next 10 years, 20 years. And they have to accept the deal, right? And slowly recover back the receivables over a long period of time. Next is investment and derivative asset. So it's quite straightforward. So if this company really invests in, say, other equities, in bonds, um, in forex, swaps, and things like that, a bank's instrument, then this will be parked and value under here. And deferred tax asset. So this could be overpaid tax or tax credit that they feel that they can claim back, will be parked under here, right? So have you noticed all this information as well, right? The company is growing, is property, plant, and equipment, but the business is not really growing. So why is it investing so much again? Or could we maybe see a recovery because the company is reinvesting in its business quite aggressively? The profit has not been showing yet. Maybe this company is on a recovery and could be a turnaround opportunity. All the others, I think we have mentioned it as well. So I hope you have caught that before I highlighted it to you. Next part, let's look at the current asset. So these are things that the company has that is more liquid, most likely easily turn into cash within the next year. So this will be the inventory that they have, trade and receivables, right? The this is the amount the customers is owing them and should pay them back within this year. So, what are some of the key things that you saw just by looking at this statement right here? I'll give you a minute to think, but I'll go through with all the every single line as well. First, contract asset, meaning that these are contract that is done, but they could be still collecting some money left. Other investment similar to just now. Contract costs will be interesting. Why is it here? Maybe just a rounding error that they need to offset somehow. And cash equivalent. So this will be cash. This will be if they buy some fixed D, will be parked under here. And then they have interesting line here called asset held for sale. So these are companies that this is a company that they have already sold or an asset that they have already sold, but they have not hand over yet. So it's parked under here. And hopefully when they sell it, they'll get cash for it. So it will become cash, right? So you can see that the current asset is about 2.9 billion at the end of last year, but the total asset is 18.178 billion. So the current asset is quite a small portion of the asset. So what is it telling us? Just from here, like looking at the asset clause, we found out more information. This company should be a very capital intensive business that they need to invest a lot in hard asset, and most of it will be tied into long-term asset that they need the equipment or the property, a big space or whatever, to build the business. And a key getaway, a key giveaway is that they have some contract asset. So most likely this company is in the contract line. So construction, doing project management, um, things like that. So they're running projects and they're doing projects too. That's why they have very high revenue, so they're doing pretty large projects, and their customers is taking a long time to pay them, right? So most likely they're doing business with the government. They have some derivative asset, meaning that they most likely have business over all over the world. Um, and their inventory is very, very small. So they're not really, they shouldn't be, right? Just by looking at the inventory compared to their revenue or compared to their asset, very, very small. Meaning that most likely this is not a manufacturing company, right? When you have a very large uh, capex business that you need a lot of fixed asset, most of the time, you can either be a manufacturing company or you can be a project-based company. So most likely, this is a project-based company because the inventory is so low, and also most likely it's not a property development company because the inventory is so low. They don't have any work in progress, or things like that, right? A works in progress will be like contract asset, but it's also very small, right? Typically, if you do property development, those will be pretty high. So again, just from a few lines, we have deduced and we have found out more and more about this company without understanding any ratios. Right? We don't have to do any ratios of the company. We don't have to do any calculation, and yet we have found out a lot about this company. Yeah. So take a breather, and we'll go on to the liability side. So this is just a flip side. The liability is the amount and things that this company is owing to someone else, and they should need to pay back over time. And this is the current liability, meaning that this should be settled within that year. Yeah, should be settled within that year. So payables would be the amount that they need to pay back to their suppliers, number one. Contract liabilities, maybe to their subcontractors and things like that, they need to pay back. Derivative liabilities could be they're doing some swaps, forex swap based on their contracts that they're getting paid in other currency, then they want to move it back to Sing dollar. I just get an example, right? I'm not saying that is the case for this company, but that is the example. Provision, um, some warranty that they might need to provision for, some uh, some VO that they need to provision for, things like that. Current tax payable for this year that they need to pay back the tax that they have not paid. Lease liability, things that they are renting or leasing, and of course loans and borrowings from the banks, right? Something that they have borrowed from the banks. And liabilities held for sale. So remember, just now we have asset held for sale. So this is maybe a subsidiary, a small subsidiary that they are planning to sell off, but still holding in their hand at the moment. And one more thing that straight away, by looking at these few numbers, jump out to you, especially, would be if you see that their current liabilities is about 2.7 billion. Their current asset is about 2.9 billion, meaning that it's pretty close, right? So, uh, more evidence that this company most likely runs project because they're just matching whatever liabilities that they have with the asset, right? When running the projects, and this company balance sheet might not be very strong, even though we haven't seen the entire picture. But because the current asset is just enough to cover the liabilities, meaning that it's running a pretty tight ship. And if anything happened, anything didn't go according to plan, the company might have some cash flow issue, might need to maybe put on more and more debt to weather through the storm, or uh, the company uh, would need some form of new capital injection, either from the shareholders or whatever, to help them cover if a shortfall is to happen. And in fact, you can see that last year, their current liabilities is actually more than their current asset. So last year, they actually run into negative territory where whatever current asset that they might have is not enough to pay back the liabilities that they owe for that year. Okay. Oop. And something else to note is that, okay, what we found out is the large portion of the payables, right? They have a close to 1.6 billion of payables that match back to the income statement on the cost of sales, cost of goods sold, right? Because whatever direct costs they have to the to making their product, they have to pay back to their supplier, right? That is cost, and you can see that uh, what they need to pay back the suppliers is actually quite a substantial amount, about 32% to the cost of goods sold for that year. What we can imply is that, okay, maybe this company takes about 4 months to pay back its supplier, right? 4 times 3, 12 months, right? Because 33% of it is currently sitting in their payable books. So maybe every 4 months they pay their supplier, so then they'll clear the cost of goods sold 3 times a year, 33, 32 times 3, roughly about 100%. These are just some deduction that we can come off with. And contract liabilities and provision highlight to us that there might be some sort of warranty, right? So after their projects, they need some sort of warranty for long-term projects. And most of the business still funded by loans and borrowing, which is a pretty high number. Yeah. And we'll end off by looking at the non-current asset. These are non-current liabilities. So these are non-current, meaning that they would need to pay back in the next few years, not directly, but in the next few years. And you can see straight away the biggest sum is loan and borrowing. So they owe the bank about $8 billion that they need to pay back over time. They have other things. I think these are all things that we have talked about previously. So that is one key thing to note. And their non-current liabilities as well is make up most of it, close to 10 billion out of the 12.5 billion total liabilities. And we get a number called net asset. What is net asset? Net asset is basically all the asset that the company has, where we go back 18.178 billion minus all the liabilities that the company owe, which is 12.519 billion. The remaining, so meaning if this company today say that I don't want to do business anymore, let's sell everything that we have and pay back everything that we owe other people. The remaining sum is about 5.659 billion. This will be the amount that the shareholder will be left with. Basically, this is what investor has in the company. Yeah. And net asset, another word for net asset is equity. And this is the breakdown of equity. Typically, for investors like ourselves, it's not that important, right? The equity is our portion. The equity, but something to note for this company, because they have something called non-controlling interest. What is due to investor that investing in this company is actually the equity minus off the non-controlling interest. And so why this non-controlling interest come up is when they have a case like this, right? This could be the company that we are investing in over here, the holding company, and somewhere along the line in their subsidiary, they have a company where they maybe only own 98% and they don't own 2%. 2% is outside party. But when they do up this financial statement, they will count this subsidiary as 100% because they control it. So they would put everything together as 100%. And then only at the end, they will say that, okay, but this external partner actually has about a 2% stake, and that 2% would be worth here $298 million to them. So whatever the shareholder of the company has has to minus off the non-controlling interest. For most companies, this is a very, very small number. But once in a while, you'll come across a company where they have very, very large non-controlling interest. Typically, this will be company where they need external local partners to help them uh, be a local partner to do the business there, and other reasons that they might have non-controlling interest. So it's a good thing that you can find out why that is the case. Yeah. So we gone through quite a lot today. Starting from just the income statement and looking at the balance sheet, right? And I spoken that in every financial statement and in every company when we look at, there are three main statements to look at: the income statement, the balance sheet, and also the cash flow statement. It's a very big topic, so I'll leave the cash flow statement for the next webinar. But you can see that just by understanding the income statement and balance sheet, we have already known so much about this company. And you can already sort of decide if this is a company that you might want to invest in, and what is the angle for us to invest in such a company as well, right? Before I go on to the next slide, Yo have a question, and let's look into it. On the previous slide, the net current asset is 451. Net current asset. This one? Okay. The net current asset is 451. Okay. He's asking what is this 451 means. So net current asset is basically the current asset minus of uh, the current asset minus of the current liabilities. But you can see that the current asset and the current liabilities actually is only about 200. And then the other two, close to 200, comes from here because they have some asset held for sale that is still under their care here. That has some balance as well, right? So if we disregard this, yes, their net current asset is just around 200 at the moment. Yeah. Great question and great observation. Thank you very much. Let's get back. Okay. So comes to close to the conclusion. Before we go on to the next week session, can you guess what company is this? Come on, let's take a guess. Uh, I hope you guys join in this little game. So we have gone through a lot. This most likely is a Singapore company doing quite big business, 6 to 7 billion. Margin not that great. The revenue is dropping, even as inflation is increasing. Most likely in the contract space, projects based business, because uh, the inventory is not that high. What are some of the companies that you can think of? And most likely a company that is doing business with governments around the world. No, no guesses? Okay. It's Sembcorp Industry. And this is a company that indeed is going through some restructuring over the last few years. But yes, they are in the project space and dealing with many governments around the world, helping build power station, building up infrastructure for business and for governments, sometimes owning the utility for a while as well. So there you have it. and you can go on the financial statement for many, many years because reading annual report and the story of companies as investors, right? To me, I always see myself as just watching a never-ending soap opera. Every single company has a story, and instead of telling it through words, they're telling us through numbers. Because if we only read the words, no management is going to tell us the negative side of the company. And if when we are reading the news or we're reading uh, press release that the company is putting out, we will always get the rosy story. But behind the numbers is where we'll get the scandal and we'll get the drama. And that makes it a more fulfilling story in my mind and a much more satisfying story to know. And that's the truth of it, right? If this is something that you enjoy, uh, definitely I encourage you to read a little bit more. And it's worth noting that, just because we see something negative about the company or something bad they have done in the past, we don't have to be too critical because no one is perfect. No one is perfect. No company is perfect because company at the end of the day is run by people. What we want to do is to understand that whether number one, the company has learned from its mistake and will become better in the future, or it is at such a cheap valuation that we can look through its flaws, basically. And that's the question that we should be asking. Is it worth it? And the numbers will show us. All right, I hope you enjoy this 1 hour session with me. And a lot of things that I talk about actually comes from my own investing philosophy and investing strategy, where I focus a little bit, I focus more on finding key, very, very long-term growth opportunity in the market, either the geographical market or uh, like long-term uh, industry. I also focus more on risk management when it comes to investing. That I try to look at stocks or companies that has a higher chance of survival rather than always going for one that has the most potential out there. And I try not to time the market, right? In fact, I feel that the more we try to time the market, the more mistake we end up making in the market. And so it's important that we find great companies to invest in, but then also keeping calm when the market don't agree with you temporarily. And I wanted to create something for what I call an everlasting portfolio, something that we can do on an ongoing basis, constantly, regardless of how the market is reacting, and we can build the portfolio over the long term. And that is also something that I try to um, share with my clients and hopefully build all this portfolio for them for the long term. And this is because over the last 16, 17 years, I have seen that effect on my own portfolio. This is a tracking of my own portfolio over the last 16 years. And I've seen the results of keeping the consistency and keeping the faith of investing in great companies for the long term. And I'm doing that for most of my clients, sometimes uh, through mostly through ETF. And I feel that a big part of it is of investing for the long term comes down to actually asset allocation. And ETF is one of the most cost effective and also safe way for us to manage such a portfolio to invest in industry that is is doing well for us and in the most diversified and cost-effective manner, right? Thank you so much for your time. Uh, if this is a discussion that you wanted to speak with me on a one-on-one basis more, right, on understanding more about helping you come up with scenarios for your own situation to plan out what you want to do with your investment or how we should go approach your investment, I encourage you to reach out to me through either this QR code or you can click on the link in learnwithstanley.com. If you just go to my website, learnwithstanley.com, and scroll down, you'll see this financial free check symbol. When you click on it, it is a Google Sheet that you can fill up for me to reach out to you, right? And thank you very much. My name is Stanley, and I do work with iFast Global Market, and we are based in Johor Bahru. And if you are in the area, you can also reach out to me. If not, you can always continue to follow me at social media. And mainly, I share through these three channels, either my LinkedIn, my Facebook, or my YouTube. You can find all the links at learnwithstanley.com. So thank you so much. And I just want to highlight to you uh, a segment that I do most of the time is what I call a spin-off section, where these are things that I have come across over the week and I find interesting and I wanted to share with you. So recently I just finished a book by Han Kang, The Vegetarian. I read a few books of hers. She come to my attention because of course she's one of the first Asian writers and Korean writers that have won the Nobel Prize in Literature. And I had read some of the books, but I find this one in particular very, very interesting. It's very, very weird though. So if you're into a little bit of weird books, you can check this out. But after reading it, I have a lot of thoughts, and uh, it left me thinking for a few days about the book. It's really a story about a personal struggle for personal freedom and a quiet rebellion, right? When you are powerless to fight the system, to fight the people who are controlling you, how do people react to it through quiet rebellion? And at the end, also, it blurs the line between sanity and madness. And the way that she write it, because she write it from a perspective of all the different characters within the story, and it really captures the mindset behind every single character. And as I was reading it, it really blurs the line of what do we consider sanity or what do we consider normal behavior. Um, all around, very good book, and I would encourage if you're into novels and if you're into literature. Hope you like that. And I'll end a quote from her called "Time is was a wave, and almost cruel in its relentlessness." Uh, I hope you get the meaning of it. And yo, thank you so much. I think you mentioned something about your calculation. Why don't we take it offline, right? And I'll chat a little bit more about you to if you are interested to know more about how the details on the financial statement as well. Thank you all for your time this week. I hope you have gotten value, and I really enjoy speaking with you guys. Hui Bian, Junhao, Christina, I can see CH, come. Thank you so much. See some familiar names as well. Santa, Tan. Thank you so much for joining me. And I hope to see you in the next webinar. Till we meet again. Investively, guys.